Good morning, everybody, and you're all very welcome to this morning's webinar on investment fundamentals, due diligence, and data rooms. And thanks for joining us today here. It's a damp day down here in the southeast, so hopefully it's warmer and nicer wherever you are. So we're delighted today to be joined by Richard Watson of Furthr VC and Stuart Fitzgerald of Fitzgerald Power, who are going to bring us through a whole story about what you need to do to prepare for investment. So we spend a lot of time here in Southeast BIC working with our startups, preparing them to meet investors for the first time. But what we also need to get into the mindset of is the plan of action after that, and what is needed and what investors expect once that process kicks off. So I want to tell you briefly a little bit about who we are and what we do here in the Southeast BIC. We support entrepreneurs developing innovative enterprises with global ambition. So we work with what's effectively called high potential startups or pre-high potential startups. And we do this mostly on a one-to-one basis. And clients engage with us at any stage along the startup journey. So we work with companies mostly within the EI criteria of a high potential startup and in preparation for their pre-seed instrument, the pre-seed start fund. And then as a startup progresses to a seed round, we prepare them for that seed investment round and hopefully that they will become an invested HPSU by Enterprise Ireland. So we will send, just by the way, sorry, this is all being recorded, will be available on YouTube post the event. And obviously, if you're asking any questions, please pop them into the chat. There's also a Q&A box available, and we'll address all of those questions in the fireside chat and in the Q&A afterwards. So from Southeast BIC's perspective, we work with companies at the very start, looking at the initial evaluation, early stage mentoring, business modeling, and early stage business planning. And as that startup heads off on its funding journey, we work with the company around business planning, financial modeling, looking at grants and pre-seed funding, and then move on to the point of getting them investor ready and sourcing that funding. So there's lots of different sources of funding out there. Ireland is has one of the most healthiest ecosystems, both government and private, available in Europe. And there's lots of different supports available, but it can be a bit of a minefield. And we help companies and startups signpost and understand the best funding for the best day for the part of the journey that they're at. And you can see a couple of those options along there. So we'd be delighted to talk to anybody about all of these options and about understanding when is the best time to avail of all the supports that are in the market at the moment. At the moment, there's a plethora of options around pre-seed funding. The LEO is definitely the first stop shop and is many of our high potential startups started with the LEO around feasibility and priming grants. There's big advantages in those. You're not giving away any equity. New Frontiers is a great program, and we're delighted to have some of you New Frontiers participants here with us today on the webinar. I can see some of the names. And then there's the Enterprise Ireland PSSF, the Pre-Seed Start Fund, which is up to 100,000 of a convertible loan note. And we prepare companies on a one-to-one basis to support them through that process. And all of the BICs support companies with workshops and one-to-one consultations to put in the best application possible. But we prefer to see you earlier than that if possible and work through that earlier stage with you. And then moving on to seed funding, obviously Enterprise Ireland HPSU, which needs a private investor first. The founders are brilliant at ferreting out investors amongst their own network. In the Southeast, we have active investors with the HBAN Halo Business Angel Network active in the country at the moment as well, along with lots of seed funds like Furthr, Elkstone, and we're delighted to have Richard from Furthr here, along with crowdfunding, etc. So there's all these different options, and yeah, it can be really, really confusing. So definitely talk to either us or the BIC in your area to support you through that process. Here in the Southeast, there's a team available to support you with skills around strategic planning, around financial modelling, around investment, around sales marketing process, etc. So please don't hesitate to reach out to any of us on LinkedIn or get in contact with us after this. Obviously, we don't work alone. We work very closely with Enterprise Ireland and the local enterprise offices, the New Frontiers programs, the universities, etc. And we're funded to do this by the Department of Enterprise Training and Employment. Last year, we helped our clients raise 12 million in seed and pre-seed funding, and that was an amazing result based on a fairly tricky year, and I'm sure the guys will talk about that. It's been a tricky year in capital raising, so delighted to see such extensive success by our clients over the last year. So I'm going to hand you over now to Richard Watson from Furthr, and as Richard's going to bring you through due diligence from the investor's perspective. He's a managing partner at Furthr, one of the most active early stage VC investors in Ireland, and has worked in venture capital for more than 15 years. So I think well qualified to talk about this subject. So thanks, Richard. I'll pass it over to you.
Thanks, Rosemary. Good morning, everybody. Delighted to be here. I'll share my screen in a minute and give you a little bit of an overview of Furthr. It's not the most exciting topic, due diligence, but it's something that obviously, if things are going well with an investor, it's something that you'll face. It's a good sign if an investor gets into DD. So hopefully I'll just give you some kind of nuggets of, what due diligence is from an investor perspective and sort of the key things that we look at. It won't be all encompassing, but I'll cover the key points. And I think there'll be Q&A at the end of this session rather than during the presentation. So look forward to kind of getting some questions later on. And so I'll just share my screen. Just bear with me a second. Is that okay? Yeah. Okay. So we're Furthr, and I head up the venture capital arm of Furthr. Furthr effectively is a BIC. We were called Dublin Business Innovation Centre, Dublin BIC, and we rebranded there about 1.5 years ago to Furthr. So a lot of what we do in Furthr is very similar to South East BIC in terms of supporting kind of high potential startups and helping them to start and scale in the Leinster region. But in addition to that, we also have a venture capital arm. That's the bit that I sort of my universe within Furthr that I head up. And we've been an active seed investor in Ireland, actually, believe it or not, since the mid-90s. Our current fund has been active since the end of 2019. We launched it probably bad timing just before the pandemic, so got off to a slow start. But it's been a busy few years. We've actually invested in 22 startups across Ireland, sort of since 2020, and we're almost actually fully invested. So we're looking to raise a new venture capital fund, which we'll be launching. We hope to launch in the market at the end of 2025. But our previous fund, then we invested in 40 companies. Our focus with our current fund is B2B software and medical devices, which is quite broad. Probably covers sort of 80% of the deal flow in the market anyway. And our focus is seed up to Series A. So most of the rounds that we do are sort of at seed stage, some seed plus, and the odd sort of early Series A. And our average check size is about 400,000 or 500,000. We can go up to 650,000 in a first round. But I suppose importantly, we hold back most of our fund for following on to be able to go the distance with founders up to an exit. So just a sample of our portfolio companies. I won't go through all the logos. You may recognize some of the names from our current and previous fund. I suppose one there to highlight is CareCom, one that would have come through South East BIC. Was one of our earlier investments. They're based in Waterford and doing very, very well. One of the few companies I've seen that have kind of gone to from 0 to 1 million in less than the space of a year, which is unusual. And they're continuing to scale very well internationally. So we're hoping, the portfolio there is 22 companies. Hopefully some of them will become good exits for us in the next couple of years. And sort of below our sample of some of the companies that we backed with our previous funds that have done quite well. SilverCloud is one of our good exits. They sold to a big American corporate about 2 years ago for 270 million. And that was good for us because you need these successes to make up for the ones that don't deliver a return. So I suppose getting into the topic of due diligence, what is it? I mean, it sounds like this kind of mystical process that's all very formal, but it's largely informal. But I would say it's an extensive process that we carry out really to validate the facts and identifying sort of risks and potential issues with an investment. It really occurs after you've had your first pitch with an investor, and if there's interest. I'm just going to move the box actually here to the right because it's coming with a slide there. Just so I don't see myself. So look, it's good if an investor gets into due diligence. It's a good sign. It means that there's interest past the first pitch. And as part of the DD, there's a list of standard questions that we'd have for all startups. But then, of course, every startup has its nuances, and we get into sort of as we get further on in the process, we get more specific and bespoke in the questions that we ask. it's kind of an agile and largely informal process. I mean, there are some more formal elements, I suppose, in the legal side of things, but actually a lot of it is really just setting up a series of calls, and as Stuart will present later on, then having documents laid out in the data room, and us going in and sort of looking at the data room and coming back with more questions. I mean, I suppose, why do we do DD? I mean, the reason we do it is because venture capital investing is a very high risk game, and the failure rate is high. You know, we invest with our current fund, we're investing in 22 companies. The reality is, you know, how many of those companies will actually really deliver a good return? Probably only a few will give us potentially a 10x. And we'd expect a fairly high failure rate. Now, I wouldn't say 50%, but we could have up to a third of our companies don't deliver any return. So we need to really get under the bonnet of a startup, you know, get into the weeds and understand everything that moves. Because at the end of the day, you know, we have asymmetric information about a company. The company knows a lot more about itself than the investors do. So we just need to try and find out as much as we can about the company before we invest. And effectively, it kind of allows us to sort of form a kind of an overall view of the level of risk and also the scale of the opportunity and how credible is it. And at the end of the day, does the risk return profile make sense? So do we believe the risk is manageable relative to the opportunity? I guess the bigger the potential outcome, the bigger the potential risk that we take. So there are some companies that we invest in our portfolio, you know, especially like in the fintech space, where I would say the outcomes are quite binary, and the potential upside is, you know, for us to make double-digit 10, 20x plus returns. The failure rate is probably slightly higher. And there's other companies that we look at where we say, well, look, the risk is actually quite low, but there's a potential to make a 5x. So in the context of a balanced portfolio, we're always really weighing up these two elements, the risk and the potential return, and they have to kind of stack up. So I mean, the graph there at the bottom just shows US venture returns over about a 10-year period. And you can see that the majority of investments actually lose money, or at best give money back. And there's only really sort of, you know, this is pretty accurate here, pretty representative of funds globally. Only a few percent actually give you that sort of 10 to 20x, you know, and then you get a number of the 5 to 10x space. So that's why we conduct DD. We just really want to understand what the risk is and what the scale of the opportunity is. But this is kind of, these figures aren't totally precise, and they'll vary from one fund to another and from year to year. But it probably gives a rough indication of the kind of the various stages and the percentages that progress through these stages for us with our fund. So, you know, we probably get a couple 250 inquiries a year. We don't meet with all 250 companies, although we meet with most. Some of them that come in are, you know, they're just not suitable because they're not in the scalable, they're not in the sector that we invest in, or the geography, they're outside of the Republic of Ireland, or they're far too late, you know, they're raising a Series B round. So we filter out about 50%, and then 85% get to the stage of actually pitching to us. You know, before that used to be face-to-face meetings, but it's generally online now for first meetings, which makes things a bit more efficient. And you know, after the initial pitch, we get a pretty good sense, actually. You know, we get a good sense of the team and the stage that a company's at. And it can kind of go both ways. Sometimes we get pitch decks and we think, you know, beforehand, this doesn't look very interesting at all. And then you meet the team and you come out away with a very different perception. And the opposite, then sometimes you get great decks and you're disappointed. So we filter out, you know, more than half the stuff that comes to us for initial pitch. We filter them out. So very often they're too early. You know, the strategy doesn't fit. And what we do say is, if you're early and potentially a fit, we could have say, well, look, do X, Y, and Z, or keep in touch and come back to us in 6 months' time or 12 months' time when you've had a certain amount of traction. So a lot of the stuff that we kind of filter out does come back later on again. And then, you know, after the initial pitch, we get into sort of a follow-up call or a meeting, and we filter out, you know, we get into a little bit more detail. We'd often ask for a financial model, for example, after the initial pitch. And maybe some other things like sales pipelines. We get into them and say another 1 or 2 calls. And again, we filter out more than half at that stage. And then really when you get into the detailed due diligence, you know, that probably makes up just over 10% of the deal flow that we get. I think when you get into the detailed DD, your probability of getting investment has gone up considerably. Just about half or slightly less than half of companies that sort of go into detailed due diligence would progress to a term sheet. And then really a term sheet, from term sheet to final DD investment, really, you know, the dropout rate there is really based on companies not, we're not agreeing on valuation or not coming together. But actually, the majority of stuff that goes to term sheet stage then goes through as an investment. So probably just over 3% of the deal flow that we get, we end up investing in. So think of it as a funnel, and these are the various stages that I outlined above in the funnel, and due diligence is a key part of that kind of process. So the core elements, we look at everything really. So I have slides in each of these, so I won't going to go through them now. But I mean, the first thing is the team, and like I know it's a cliche, but the team is by far the most important element for an investor. And actually, as we go through the meetings and engaging with companies, we're really conducting our DD by getting to know the team. So it's not like we necessarily ask a series of questions or give a questionnaire to a team. We get to know them, we get to understand the personalities. And really, it's through those kind of informal interactions that we get to meet the team. We get a feel for the team. What we're looking for is complementarity. We always look for a good balance of commercial and technical. We like founders that have deep domain knowledge and deep understanding of the market. And then sort of through our probing, we like to see founders that, are open about gaps in their knowledge, experience, and the willingness to listen and learn. The best founders we find are the ones that go out and build good networks and use these networks to their advantage. Behaviors we look for: resilience, ambition, being grounded, being open, tenacious. They're all the things, they're all the kind of characteristics that we look for as we engage. And for us in Furthr, we would put a very heavy emphasis on the team, on the due diligence. I mean, we look at everything else, but really, this is by far the most important element. And as I said, it really is informal. It's just through time and engaging that we get to know the teams. We look at the organizational chart and future key hires. We always want to make sure the founders are aligned with us before we invest. We both have to be looking at the same things. There's no point in investing in a company if the founder's ambitions are to build an empire and not to exit sort of, for 10 or 15 years. All venture capital funds have a life typically of 10 years, and they're looking for the potential to exit within sort of 5 or 7 year time frame. So we need to make sure there's alignment on that. And the most important thing then is, can we actually work together? It's a long journey. It's a marriage with a planned divorce, but there's going to be lots of ups and downs along the way. So we have to get on. The chemistry has to be good. But I suppose the team is, the most important element for us. And it's probably the most informal sort of part of the DD, but the most critical part overall. I mean, we look at all the different elements in the business plan, so is the market large enough and growing? Is the timing right? That's a key thing that we really look at. We've made investments in companies before, in the sort of EV charging space and biofuels, and we thought they were the best thing since sliced bread in terms of the value proposition. But we got stuck with a few investments where the market time was just too early, and equally we've gone into some where the market is too advanced and too mature. So we spent a fair bit of time trying to understand the market timing and making sure that it looks okay. We look at sort of primary and secondary market research that the company has done. We're always impressed by sort of early stage companies that have gone out and done their own qualitative research, engaged with customers early, maybe done some questionnaires and so forth. So we look, all of that sort of feeds into our overall picture of the company's understanding of the market. And the one thing you really need to have done, we see a lot of pitch decks where there's a competitor matrix or competitor positioning. That's fine for a presentation, but really, if we're interested, maybe in the next meeting or the meeting after that, we're certainly going to look for a detailed competitor analysis. So we expect founders to have done, to obsess over the market and the competitors and have that sort of set out in a spreadsheet or a detailed table in Word. Looking at all the strengths and weaknesses, pros and cons versus the competition. So that's something to have ready in your data room. We look at the product, obviously the current stage of development, the feature set. Then we look for sort of roadmaps. This is another thing that we look for, maybe not in the second or third meeting, but as the DD goes on, looking for Gantt charts, development plans for sort of short to medium term R&D, and then maybe longer term overall vision. What is the gross margin currently, and if you're a product, what are your plans for sort of volume manufacturing, and how will the margin change over time? So we look at all of that. IPR, intellectual property rights, not relevant for most software companies. We don't expect software startups generally to have filed for patents, except for some of the spin-outs from universities. But we do a lot of medtech investing, so we spend a lot of time looking at the papers that have been filed, granted, planned, You know, we did one of the medtech, we did a medtech investment in a company called Gascon, just at the end of 21. And they're doing very, very well. They developed a device for removing air bubbles from IV lines. But, you know, before we invested, we noticed there was quite a bit of prior art in that space. And, you know, there's a little bit of worry that maybe they might be infringing on other patents. So one thing that we actually asked the company to do before we invested was to, you know, work on a freedom to operate, to recruit an independent patent office to conduct a freedom to operate, to give a kind of a legal opinion as to whether you know, they had freedom to operate, and it came back very positive. So that was something that we did then. But certainly, whenever this patent evolved, or it's a spin out, we'll look at that in detail. We'll also look at license agreements, of course, as well for spin outs. You know, product market fit, you hear about that all the time. We really like to get, you know, you do actually get a sense from just talking to the founders ahead of everything else, how well they understand the customer base. And that's, again, that comes out really through informal interactions with founders. Sales traction is obviously the best proof of all. You know, and that's, you know, companies at seed stage, sometimes they have customers, sometimes it's a big pipeline, and we kind of look at that in detail. I suppose one thing that surprises some founders is, you know, customer calls. So that is something that we do, and it's a very important part of due diligence. We'd only really do that as things kind of get to a more advanced stage, because we are aware of the sensitivities that founders have about not appearing like a startup, and you know, we're conscious of not trying to scare or put off potential customers. So we have to handle that delicately. But this is a key part of our DD, and where there is traction, we normally have sort of 4 or 5 customer calls, find out, you know, customers' perception of the product, you know, the service, the company, you know, new features that could be added, and so forth. So this is a kind of a critical part of DD. So don't be surprised when investors ask you for sort of some customer context to make calls. But we look at the business model, of course, in detail. The pricing model is one thing that we really drill into. You know, we like to see land and expand strategies, companies getting in maybe with core product, and then seeing, you know, showing the ability to upsell other features or other products. Obviously, there's often not evidence of that with the companies at seed stage, maybe when you're just signing up your first customers. But we certainly like to see that in the plan, and sort of drill into the pricing model. We also accept that the pricing model will evolve over time, and probably evolve up to and beyond even a Series A round. But I suppose one thing we look at is, you know, what do we need to believe for the company to get to 1 million ARR and then 10 million ARR? I suppose the reason I say 1 million ARR, it's probably a little bit higher now, is that's kind of an inflection point maybe that would position you to raise a Series A round in very crude terms. And 10 million is kind of a very crude measure for, well, you get to that level, you know, there's a good chance of an exit. Although, you know, some companies are acquired well below that and some higher than that. But, you know, what do we need to believe for the company to get to 1 million and 10 million in ARR? So, you know, the go-to-market strategy is a key part of what we drill into. And actually, that's often the thing that really, you know, this go-to-market and the sales pipeline, you know, this is often the thing that really kind of will make us really keen to invest or not. You know, when I spoke about ClearCom being, you know, a company that came through Southeast BIC and they're based in Waterford, we invested in them before they'd actually signed up their first customer. But they had a very, very clinical sales approach, which they sort of garnered from, you know, working in the space previously, and just the level of detail and their ability to demonstrate the pipeline that they built up, and very, very sort of clear vision of how they would scale, you know, was very, very positive for us. And that was probably the thing that really swung it for us, was their focus on sales and the credibility in the area. So, you know, we look at the sales channels and planned sales volumes by channel. You know, if you're, I mean, ClearCom are what I call a high ticket, you know, they don't need an awful lot of customers to get to 1 million and 10 million in ARR. But of course, there are businesses where the ticket price per customer is, you know, sub 10K, and therefore you need a lot of customers to get to the 1 million and 10 million. So we look at the unit economics, you know, the long-term value of the cost of acquiring a customer. We've got to see that stacks up. Conscious of time here, actually, time always goes much quicker than you expect when you're presenting. So I'm just looking at my watch. The sales pipeline, have that ready, have that in your data room ready for investors, similar to the competitor analysis, because that's one of the first things that we'll look at. So have that ready in sort of Excel format, and, you know, ideally you would have exported that maybe from a CRM We want to see granularity in that, and we want to see, you know, the stage that a company is at in the pipeline, you know, the next steps, the potential first year ARR, the long-term ARR. And then, of course, it's okay to put in probabilities, but make sure when you put in the probabilities that they're sensible. You know, I did have one company there a while ago where they gave us a pipeline and they had some in it sort of prospects, and they had them down at 35%, I think. And so we asked them, oh, what stage are we at with the prospects? And they sort of replied, say, well, you know, these are just companies we've identified. We haven't even spoken with them yet. So, you know, it's not a scientific exercise, but, you know, it's better to be a little bit prudent and conservative when it comes to some of the assumptions in your sales model. And then we look, of course, you know, we really look at the sales pipeline, and we obsess over the next year, 6 months to a year. What do we think the company can achieve based on the pipeline that's there? You know, what is the sales cycle, the conversion rate, the ARR per customer, etc. Then it's sort of the financial side of things. You know, we look for management accounts. We don't expect any companies to have audited accounts. You know, that's typically something that once we invest, we look for companies to do audits, or audits to occur in the post investment. But it's really just having your management accounts up to date. So again, another thing to have ready in your data room. We always look for, this is probably the first thing we look for actually after a deck, is the financial model, because you're going to learn an awful lot from the model, you know, and we want to see a model with all the assumptions and calculations intact. We don't want to see, you know, summaries that are going to pay special where there's no, you know, they're just absolute values. We want to get in and actually understand the assumptions behind the sales projections and the operating costs, look at the hiring plans and salary assumptions and so forth. So, you know, this is something that you really need to have ready from the get-go, because there's so much that an investor can learn from the financial model, and it avoids us kind of coming back with tons and tons of questions if we can actually get in and understand the assumptions. We also look to do sensitivity analysis, and even better if the company has done that and run some distress scenarios. We'll do that ourselves anyway. But what happens if sales come in 50% below what you're projecting? Because let's face it, most time, 99% of the time, sales do come in below projections, entrepreneurial bias and things taking longer and so forth. We want to see at least 18 months runway in a stress sales scenario. So that's, we really spend a lot of time on the model. And then the cap table, we look at that, have that ready as well. You know, we want most of the ownership to be within the management team. You should show it on an as converted, fully diluted basis. So if you raise money on convertible loan notes, show it on an as converted basis, assuming some conversion scenarios. You know, the provision for 10% ESOP, you don't necessarily have to have that in your cap table. That's something that we would work with you on. Certainly it would be a condition if we're going to invest, that this 10% ESOP in place post investment. And then we spend a lot of time looking at the exit scenarios and sort of, we like founders that have really demonstrated an understanding of this, and that they've really thought about this in detail, and understand who might acquire you and why and what they would look for. We see that especially with medtech companies. We always look for them to engage at an early stage with potential acquirers, and what do they need to find out what they actually need to achieve, what stage they need to get to become an acquisition target, and showing examples of other exits in the space and the value drivers for those exits. So very helpful. And then look, there's the legal side of things. So have all this stuff ready, you know, the fairly fundamental stuff like the company constitution, share register, some other filings with CRO. If you've raised money before, having the investment and shareholder agreements and other viable documents available. Employment contracts we always look at as well, especially for the management team, license agreements, and other commercial contracts. And then just other, I suppose, another thing that's becoming very prominent in DD now is ESG. You know, we with our portfolio companies now, for the first time, we've had to send out an ESG questionnaire from Enterprise Ireland. You know, so this is all, the reporting around ESG is becoming very, very prominent now. And we have to report on it to our investors in our fund. So we now sort of would include sort of ESG questionnaires as part of our due diligence. So just something to be aware of. It's tough in startups, so you know you don't have to go reinvent the wheel. But what I would say is maybe go out and talk to others and beg, borrow, and steal sort of some policies, you know, some boilerplate policies in place around sustainability and just employee welfare and so forth, governance. But that's it. I know I covered a lot of ground and time flies, but I look forward to getting any questions at the end. Actually, the final comments, I suppose, just have your house in order, be responsive to investors. The process was going to take time. You've just got to be patient and be prepared to be distracted. Be open and transparent with investors. We don't expect perfection, but you know, we're going to find things out. So you're better off just being completely open and honest. We like that with teams. And of course, then you do your own DD on investors too. Go and talk to other funds that are other companies that have raised money from them and find out, you know, the sector style, the fit, the value add they bring, and so forth. So the due diligence does go does go both ways. You know, it's a long-term relationship, so you need to have done your DD on investors before taking investment.
Excellent.
Thanks,
Thanks, Richard. That's great. That was really comprehensive, actually, and it's great to hear it from the horse's mouth. You know, we hear about this kind of stuff all the time, and it's great to see it all in the one place in a clear order. So thanks a million for that. Stuart. Listen, we're delighted to have Stuart Fitzgerald. He's Fitzgerald Power's Chief Executive Officer, Fellow of the Chartered Accountants of Ireland, and provides strategic accounts to enterprises across Ireland and the UK. So, Stuart, you have great experience in this area. You work with companies, multinationals, SMEs, startups on acquisition, disposal, corporate fundraising. So what you don't know about the organisation of a data room isn't worth knowing. Do you want to share your screen and we'll kick off?
Yes, thanks very much. And that was one of the nicest intros I've ever had. I usually get booed. So let me see.
You're hanging out with the wrong people, Stuart.
You're right about that. Let me see. Sorry, no. Rosemary, tell me if this is working okay. Are we okay?
Perfect.
Yeah, good. Okay, Rosemary, thanks very much. Great to be here. Yeah, as Rosemary says, we are a mid-tier accountancy and business advisory firm that works with scaling companies who are looking to raise rounds at different stages. So it was great. I found that really good. Richard's presentation, and what we tried to do, myself and Richard, is to not overlap with what we're doing. So this is just very much like a step-by-step guide to setting up a virtual data room and what should be in it. But just a couple of notes I made when Richard was speaking, and this, I suppose, speaks to why this piece of the process is important, is that if you look at the filtering process, they're only seeing 12%. Only 12% of the deal flow that they're seeing is getting as far as DD, and only 3.5% of that is getting to deal flow. So, you know, every time an investor like Richard is looking at a prospect, looking at a pitch deck, looking at the financial model, looking at the team, and looking at the virtual data room, they're taking a proxy for quality. And all of these little signals that you're sending are effectively feeding the filtering process that Richard and people like Richard are considering when they're making their selection. And what he's talking about when he talks about the failure rate in venture capital investing is what's called the power law. There's a really good book called The Power Law by Stephen Malaby, which just effectively goes through the failure rate and how much of the return comes from the fat end of the tail, effectively. So getting this element of the process right is essential. We've had clients who've used Google Docs and stuff to organize data rooms. It's not advisable. Doing this properly, setting it up properly is important. So first thing is to select a suitable VDR system. Here's a couple that would be common in the market. Intralinks is probably more sophisticated. We use Firmex. I think I have a little matrix at the end which goes through some of these, and maybe boxes is the most appropriate. But selecting something that can effectively manage the process in a very organized and streamlined way, and can give your potential investors access to the information in a way that's professional, that sets the process up for success is really important. So in this step-by-step guide, the first is to choose a VDR partner that meets the requirements of both you, the company raising the money, and indeed the potential investor coming into the process. So once the VDR is selected, this piece is relatively intuitive. You select your VDR, you're signing up for an account, you're customizing the settings within it, and then sharing that out with potential investors. Now, in terms of the organization of the documents, so Richard has gone through quite a bit of this, and some of the areas that would be commonly within a VDR include financial statements, business plans, pitch decks, IP documents, legal agreements, product roadmaps, growth metrics, market analysis, and customer testimonials and case studies. It was interesting, the customer piece, and we were actually discussing this in a preliminary call. I think it's sometimes underestimated by startups how important getting a good sense of the customer and client experience is for a potential investor. And they will often want to speak to directly to customers, but actually getting some information into the data room in an organized fashion that gives them preliminary understanding of what the customer experience and appetite is like is very important. Getting these documents organized in the right way is essential. So the VDR architecture is something that you can't spend too much time on. It should be intuitive, it should be straightforward, but you'd be surprised how often people get this wrong. So take, for example, the financial statements. Within your VDR architecture, there should be a folder and subfolder architecture. And for example, a finance folder would include financial statements, and within that folder you would have your financial statements. It would include a subfolder for management information, which would include your management accounts. It would include a subfolder for budgets, which would include your budgets and forecasts. And it should be just really, really straightforward and intuitive and easy to navigate. And what you're trying to do here is effectively make this as simple as possible for someone to make a decision to invest in your company. Any friction points, any areas that make it difficult for people to get to the answer that they're looking to get to is going to affect your ability to raise the round. And at all stages, as I say, they're taking a proxy in terms of the quality of the investment, the quality of the team, and the quality of the potential opportunity. Because no matter how much diligence a VC will do, no matter how much time they put into it, they know that ultimately it's a very, very difficult assessment to make as to whether or not one of these opportunities is going to be the next ClearCom. So making it as easy as possible for them to get to an answer that aligns with the outcome that you're looking to achieve is essential. So the VDR architecture, you can't spend too much time on getting that right. Setting the permission access would be the next important piece, and all of this is managed within the VDR itself and is straightforward to do. But you may set different permission levels for venture capitalists like Richard, for advisors like us, if we're assisting in the process, and for other stakeholders. So other stakeholders could be the likes of Southeast BIC, could be the likes of Enterprise Ireland, and in some cases, the permission level access will be the same throughout, but in other cases, you may want to manage specifically who sees what. Particularly if it's a competitive process, what is being viewed by some potential investors may be unique to them, and ensuring that is organized and controlled and managed in the right way is essential from a security perspective. So once the documents are going in, if you've selected a sophisticated enough virtual data room, you'll be able to watermark the documents. If not, you can do that offline. That's important. We would often do that as an extra layer of security. It just means that someone is pulling down a document out of the data room. It's a PDF, it's watermarked, it's very clear what the purpose, the watermark would say what the purpose of the document is, and it'll just prevent usage in any other unauthorized situation. Encrypting certain documents for added layers of security. If there's something that's particularly sensitive, it could be something in relation to IP potentially. And then look, the final piece just around tagging just helps with access. So again, this is about making it as easy as possible for the participants in the data room to access what they need, how they need it, when they need it. Not unlike a good webinar, a Q&A section is essential. And what you want to be seen to be is as transparent as possible. This is a point that Richard talked about. So like when you're getting ready for investment, effectively you're getting ready, as Richard said, for a marriage that will ultimately come with planned divorce, but ultimately it's a relationship. And building transparency, building that relationship early on is essential. And being seen as a team that the VC can work with, and a team that can really develop a relationship that'll help to deliver the best outcome for the VC and the founders is essential. So building transparency by being very responsive as questions come into the data room, because there's going to be a lot of questions. If you're in the stage of detailed diligence, it's a great sign if you're getting lots of questions, because it means there's really good interest and they're trying to understand the opportunity, and they really are looking for, it's a bit like the Six Nations, can we award the try? They're looking for reasons to do it, not to do it. So being responsive, being transparent, and streamlining communications is really important. The other thing, and Richard may not like this, the other thing that I like about having the Q&A section is that sometimes it creates competitive tension in the process. So it may not be a bilateral process. You may have more than one party who are looking to invest, and it's always good from a company perspective to send a signal that this is a process that's competitive, because in any walk of life, I guess, if an investor and acquirer of a company feels that the process isn't competitive, that may be reflected in the terms that you get. So finding ways to communicate through the Q&A section that the process is competitive, if it is, has its own value. So once the links are going out, you're sharing them with your potential investors. Being really clear on the instructions is important. So really setting out what it is that you're sharing, how it can be accessed, who has access, how the different elements of the data room work, what the architecture is, what they can expect to find in the data room is really important. We would always send data room rules, which will be signed electronically before granting access. Data room rules are effectively like a longer non-disclosure agreement, which effectively governs the usage of the documentation within the data room. And look, it's just an extra layer of comfort. I mean, if you're dealing with a professional VC like Furthr, they'll probably expect it, but in any event, they'll have no issue with it. And getting that type of security in place, I suppose, look, it's another proxy for professionalism as well. And it shows that you're well organized and well considered in how you've approached your funding round, albeit an early funding round. So tracking activity is the next important step. So the data room that you select should have the facility to monitor what's happening, who's accessing what data, how active they are in the process, how engaged they are. Obviously, the Q&A is a proxy for interest as well, but monitoring activity from potential investors to see who's doing what is a really good way to build an understanding of how the process is going, and how likely you are to receive a positive outcome. So the statistics that come out, the tracking and activity statistics that come out are very, very useful. As is managing updates. So diligence can take a number of months, and it may well be that if your year end is April, that when you initially start the funding round, it could have been the end of January, and there could be a 3-month update, the Q4 of your financial year update, showing your performance against the financial budget. It'd be really important to get that in there promptly. Particularly if the news is positive, because it enhances the opportunity for the VC. So getting that up to date, making sure that it's communicated, and a good VDR will give you the opportunity to communicate the updates directly to your participants. Sometimes those updates, to be honest with you, can be a bit spammy. So every single time a document goes in, notifications can be sent out, and that can be overbearing, to be honest. But so a bit of management around that is important. But making sure that that you're keeping the data room fresh, and that you're keeping it populated with everything that's needed for an investor to make a decision. Ultimately, this whole process, diligence, pitching, managing the data room, is all a courtship that's designed to get the right investor to write the right check at the right time so that you can scale your company. It's as simple as that. And all these elements, all these different elements along the way, are just designed to achieve that outcome. And there's none that are unimportant. So every single step of this needs to be properly managed, needs to be professionally managed. And I know I'm like a broken record with this, but it is the facts. Every single interaction that you have with a potential investor will be seen as a proxy for the quality of the team, the quality of the investment. So keeping this stuff fresh and up to date is really, really important. So ensuring security, this is really from your perspective, because you're going to be putting lots of sensitive data into the data room, and obviously you're dealing with professional counterparty in most instances, and they will respect the confidentiality, but ensuring that the appropriate level of security is in place and is managed, and also once the process ends, particularly if it's unsuccessful, that you're that's managed appropriately and access is restricted after the process ends, etc., is really important. This is obviously a representative photo of what it's like to work in a tech security office, nice and breezy, lots of foliage, but providing support throughout the process is important. So you're dealing with a really, really busy counterparty. You've seen the stats from Richard. They're looking at lots and lots and lots of opportunity. They're trying to filter them as best they can. In lots of instances, their resources aren't massive, particularly early stage investors. And the quantum of opportunity that an early stage investor has to see to filter out the ones that they want to invest in is colossal. It's a huge amount of work. So providing support during the diligence process and during the interactions with the BDR is essential. So if there's questions that come in about where are documents or how do I access, or for some reason I can't get into the BDR, dealing with that promptly and being on hand to manage the process is essential, and it'll make everything move more frictionless, and it'll set the potential manager for success. So I just said I would include these at the end. They are the three that I was focusing in on. We use Firmex. We've used Intralinks quite a bit on some larger cases. I probably think it's overkill, to be honest with you, for an early stage funding round. But there's links to all of those potential VDR partners within that little matrix. I mean, if you're going to partner with an advisory firm like ours, something like Firmex or Intralinks will be part of the package. If you're doing it directly yourself, something like Box probably ticks the box and works perfectly well. And I suppose you're looking at the interplay between investment, cost management, and actually doing a professional job and giving the potential investor what they need. And that is really it. I'll stop sharing the Rosemary.
That's great. Thank you so much, Stuart. That was really comprehensive. I've learned an awful lot today from both yourself and Richard, so that was excellent. Thanks a million. We do a few questions, and I know Aidan has a few thoughts on all of that, so I'm going to hand it over to Aidan now. And
thanks, Rosemary, and thanks, Stuart. Thanks, Richard. I think it was fascinating to hear both sides. We hear an awful lot about due diligence, and we kind of preach that message ourselves. But to see it laid out in black and white in terms of on what's the actual due diligence process from Richard, and then from Stuart to see how this thing needs to be organized and structured and presented. And that kind of leads me to my first question, I suppose. And I would encourage anybody on the webinar today, do put your questions into the Q&A. We have a couple in there already that I'll get to. But for both of you, how proactive are the startups and the companies themselves in the due diligence process and the data room process? Or is it dragging and pulling, and is it a constant request from the investors? We need this information. So how are startups getting better at it? Is it still kind of the investors asking for the information as opposed to the startups arriving fully cocked?
It's a bit of a mix, Aidan, from what I'm seeing. I mean, I'd say the medtech companies tend to be quite organized, because they have a lot of documents, and but for many, we're kind of extracting the information. Companies don't have their house in order, and that kind of slows down the process. So I'd say it's fairly mixed, but I mean, if a company wants it to be a seamless process and sort of move quickly, the more organized you are, the quicker the process will be, and the better, as Stuart was referring to there, that sends a signal to us. So, we pick up a lot of impressions from that whole process and how organized or not a company is. So it's a bit of a mixed bag, but I think companies are getting better. I would say over the last decade, I've seen companies get better.
Okay.
Aidan, it's
Stuart,
about
from your perspective, yeah.
it's about momentum, you know, and I think it can be very frustrating for an investor if momentum is lost, and if they're requesting information and it's not forthcoming. I would agree with Richard. It is a mixed bag. You see some very well organized companies who come into a process really ready to go, and they're very responsive, and then you see others who aren't. And I think if you lose momentum, you know, you're probably down the pecking order. I don't know what Richard thinks, but you're probably down the pecking order of opportunity, and that's not somewhere you want to be.
Okay, interesting.
Yeah,
And then,
I agree. Yeah, go ahead.
yeah, and in terms of, I suppose I don't want to get into too much of the financial piece, but let's broaden it out then maybe. I was talking about red flags with the due diligence process and with the data room. What are, like, I know from a financial perspective, it's probably there's a few things that you kind of hone in on. You mentioned some of the things there, but what are kind of red flags, I suppose, during the due diligence process or in kind of getting that data room together?
For us, I mean, one of the things we see is, you know, very lofty financial projections, and then you get into the sales pipeline and it's not there to kind of justify, you know, and it just takes away credibility. Sort of, you know, companies planning to go from 0 to 1 million in revenue, and you know, or from a low base, and projecting quite big increases post investment. The pipeline isn't there, so I suppose that's probably one big red flag for us. It's just kind of lack of credibility around the projections.
Yeah. And Stuart, what do you,
I would have to agree with that. I think performance to budget, and the marrying of the deck to the model to the actual accounts, is probably the fundamental piece. Like the VDR and the management of that, it's important to get that right, but ultimately no one is going to make a decision to invest based on the quality of your VDR. You know, they could make a decision not to invest based on the quality of it. I don't think, you know, so I would think the big red flag is financial performance. Yeah.
Yeah. Okay. And one of the things, Stuart, that struck me when you were talking to this, the companies are talking to more than one investor potentially as they go through their journey. How do investors, seed funds, VCs, do they have their own risk profile? Are some investors more risk averse than others, and do they take a different approach to the whole due diligence process? And maybe I'm coming from the point of view, let's say, with angels as opposed to VC. So it does make you ensure that startups should shop around, as it were, as well. That it's, I presume that everybody has a due diligence process, but it differs maybe from business angels to VCs and amongst VCs themselves.
It does, but I think there's a lot of things to consider. I think the right VC can have a fundamental impact on the potential outcome. So, like, cash is a commodity, and if the project is strong, you're going to raise it. But whether or not you have the right funding partner is something to really be cognizant of. Yeah, I mean, if you're going to go and do an angel round, and we've done lots of them, you could raise the money on a pitch call, and the diligence could be limited, or they could follow a lead investor in, and their diligence could be limited. What value add are they bringing other than cash? Probably limited. Maybe you may have honed in on a couple of really interesting people who've done it before, and you can bring a network or whatever. But part of what you're buying when you're selling equity to a VC is the network impact, and their ability to set it up for potential exit or for the next round, you know. And ultimately, if you get the VC right, I'm not doing Richard's sales pitch for him, but I mean, if you look at how their funds are structured, they need to recycle their money within 5 to 7 years, or else their IRR is completely shot, right? So I mean, it should align everyone to either get to your Series A or to get an exit that suits everyone. So getting that right is important. So, like, I don't think I would discount a potential investor because their diligence was robust. That wouldn't be a criteria for me. But I hear you. I mean, it'll be much more like touch with angels. There's no doubt about it.
Okay. And Richard, anything to add there?
Yeah, I mean, it's a bit of a mixed bag. I mean, I think the medtech angels now would do an awful lot of DD, whereas, you know, some of the software, you know, some of the other syndicates, I'd say, like in HBAN, you know, we've got some of the syndicates like Boole and Bloom, you know, are getting a bit more sophisticated and operating more like VCs in terms of the DD they do. Maybe not quite the same amount, but you know, we co-invest a lot with Iris and the HBAN medtech syndicate. We tend to actually share the DD because medical device companies, you know, there's just more DD. There's a lot of regulatory stuff to look at. So what I would say is that, you know, the appetite for risk is probably similar enough between us and, say, the likes of Boole and Bloom, but the perception of risk sometimes can be different. We might pass on a deal where we feel that the risk is quite high, or we have doubts about the team, and then somebody else would have a different view and they'd invest. So it's a bit of a mixed bag. And in terms of value add, then the medtech angels would be what they would typically they nearly all come from medtech backgrounds themselves. They've exited companies. So very often when we co-invest with them, we'd sit on the board with one of the angels. I mean, we have lots of medtech companies as examples, but I suppose if you look at Crevalve, it's one that we invested in. They developed a heart valve. We're only an investor in there, but they have a medtech syndicate in Iris in there. We've got somebody like Bernard Collins, who's kind of a veteran of the medtech industry, and then he set up Boston Scientific in Ireland. That's the chair, and some lifelong background in structural heart. Whereas, yes, some of the other kind of deals we've done alongside angels, and there's not really. They don't have the same value add. They might be just there as an observer, more passive.
Okay. I'm just going to get on to some questions from our attendees now. But one final question, I think it's important to talk about this, is the whole team, and Richard, you focused in on this as well. That in terms of the due diligence process with the team, how detailed is it on the team themselves? Like, is there background checks done, or as you said, it's a more informal, get you to know process? But the team is at the core of everything. It's basically you're investing in a team and they're promising to deliver on a particular business plan that they presented or whatever. But in terms of the due diligence on the team, individuals themselves, how does that work?
Yeah, I mean, first thing we look at their CVs, their LinkedIn backgrounds before we meet them. We typically do that before even the first call, just to get an idea of their background. And most of it is informal. But I suppose one thing that we would do is we would do sort of look to see who they know, who do we know that knows them, and do our own reference checks to get. So that would be a very important part of what we do. We generally try to find people that know them, that we know, and talk to a number of different people. But most of it is around just, as I said, just the engagement through the process. And then I suppose there is at the legal stage, this is one of the last things that's actually conducted, right? Literally the day before an investment closes. It's always like this, where the legal firm, that we would appoint to help us prepare the investment documents, would do legal searches. So they would do sort of, going all this kind of looking at all the courts and making sure there aren't any judgments against the founders, or they haven't been declared bankrupt. That's something that's at the very end of the process. It's very rare that something come up in that.
And Stuart, final question on the team then, in terms of the skill set within the team. Is there a lot of hand holding where a team, for example, is very tech focused and they're presented with this data room that they need to get together, and they're non-financial, they're non-legal, they're everything, they're only technical focused? Is that a lot of hand holding and something that Fitzgerald Power would get involved in terms of preparing the data room?
Yeah, it can be. Yeah, it can be. So if we were managing a process on behalf of a client, we would look after all of the management of the data room, to include the population, the folders, all that kind of stuff, and making sure, almost like a pre-diligence, that the info going in actually makes sense. Helping to build out the model. Like, sometimes you find founders who are really, really good technically, but may need some assistance in building out a financial model, etc. So yeah, I mean, that kind of assistance wouldn't be atypical.
Okay, cool. I'll just go to some questions now from the attendees. Some specific and some kind of general. First one there for Richard: for your biotech, medtech startups where due diligence with initial customers is not possible, what do Furthr perform in its place? Trial results, or expert opinions, or what?
Yeah, that's good question, actually. I should have said that during the DD, because of course all medtechs, they're kind of on a regulatory journey normally when we invest. So the key thing that we would do is speak to key opinion leaders. So we do that with all medtech investments. So if we're investing in the neurology space, we invested in a spin out there from Cork just before Christmas, Neurovel. Now it happens that I'm a biomedical engineer and background in EEG. But we spoke to a number of, it's a neonatal EEG system. So we spoke to a number of neonatologists and EEG technicians and neurologists, key opinion leaders. So that will be a key part of what we do for DD and for all medtech companies. So we've had that where we've looked at a company, we thought it's great, and then you talk to a key opinion leader and they go, this product will not fit into our clinical workflow, it's over designed, it's too expensive, it'll slow things down. So that's a very important part of our DD on medtechs.
Okay. There's a question there about tracking, Stuart, where you mentioned about tracking the documents. When a document is downloaded from a data room to a local laptop, what level of track and trace still exists from the data room provider?
Oh no, sorry. When I say tracking, I'm talking about actual activity within the data room. No, once something is downloaded, that's where the tracking ends.
Yeah, cool. And then some question here on the team: how important is it to see a company with co-founders rather than a solo founder backed team that employs to fill skill gaps? So yeah, that goes back to I think we back teams rather than solo founders primarily, I suppose, is it?
Sometimes we have solo founders. What I would say to that is, if it's a commercial founder, we want them to have onboarded a CTO and the CTO to have some equity rather than all of the equity of the company just being concentrated on one person. So we do see companies with just one founder, but we want to see a bit of spread of equity. Of course, that founder is going to have the majority of the equity, but we don't want to see a CTO parachuted in on no equity or like 1 or 2%. So we want to see a balance of equity between commercial and technical.
Okay. And then there's a couple of questions in that are kind of similar, and I know we've touched on it during the webinar. How long is a piece of string? How long does a typical DD process take?
I mean, it depends. I mean, we can actually go pretty quickly. For example, if the company is organized and there's a round that's coming together very quickly, we have actually done DD in a matter of weeks. We can actually move. We're a small team and we're nimble. But more often than not, it probably goes on over a period of time. And that's because maybe the critical path is the company, is waiting for something to happen or trying to get back with information and or looking to get other co-investors coming in as well. So we'll throttle up or down our DD based on how soon a round is expected to close. If we can see that a round is coming together and the company needs to close it in 2 months and they're highly organized, we can actually fast track our DD in a matter of weeks. We have done that. But my experience is generally from first engagement to getting a check for an investor, it's typically about 6 months. And that's because it's only as quick as the slowest cog in the chain. That might be getting co-investment from Enterprise Ireland or finding, co-investors to come into the round. So we throttle up and down based on the need and I suppose the quality of the information that's presented.
I would completely agree with that. And I think one of the biggest barriers in fairness is the info flow from the company and how proactive they are with keeping the VDR up to date and responding to queries as they come up. The other thing I think that we often see that slows deals is the quality of the legal advice. On the company side, the VC or the angel network will invariably be well advised, but it's really, really important to get a commercial solicitor, and there's a couple who specialize in the early stage tech space. And if you get one of them in place, it'll be frictionless. But if you don't, you could be looking at putting months on the process.
Okay. More of that, Stuart. We see that from time to time where they use some local solicitor who has no experience, and that just can slow things down so much.
Yeah.
All right, listen, I'm conscious of time there, Rosemary, that we promised everybody we'd be done in the hour. From my perspective, Stuart, Richard, thank you so much. Really, really insightful. And I think anybody on the webinar today really got a lot of insight and knowledge in this whole area. As I said, it's something that we kind of preach to clients, that the focus is always on getting in front of the investors, getting that pitch time. And then you're kind of saying, well, afterwards, the work then begins. If they're interested, there's a whole DD process that needs to be managed as well. So it's great to kind of get your insights today. So thank you so much for coming on today.
Yeah, big thanks to Stuart and Richard for the preparation work that they did in developing the presentations for today and the conversations we've had over the last few weeks. So we know it's a big time commitment and massively beneficial. I think we've all learned a lot today, as well as anybody in the call. This is going to be available on YouTube in the next week or so, and we'll be putting that out on our social media and sharing all the information from it. So thanks everybody for coming along. If you have any queries at all, get in contact with us. If you want a referral to another one of our colleagues in another part of the country, we'd be happy to do that. And we'll catch up with you all soon. Thank you very much.
Cheers. Bye-bye.
Thank you.